Hey everybody, this is Brent from Wolf on Wall Street Trade with a market update for the week ending May 1st, 2020. This is a weekly chart of the S&P 500. So last week we came into this prior week with an inside week or loss of momentum right here. So S&P and Dow down 0.2% this week. You can see it with the shooting star. And that's kind of what I expected because we were going into the heaviest week of earnings, and we also had the Fed midweek, and the market tends to drift into the Fed and just kind of go sideways and check out what's going on with earnings. But the week was much more volatile than it appears, as you can see with this long upper tail on this candle. S&P was up as much as 4% during the week, so a very crazy week. Here's a 15-minute chart. So the S&P was basically sideways for 2 weeks. You might remember last weekend's video, I was saying the cyclical sectors had not been acting well. And for the S&P to break out of this, they really needed to pitch in and take up some of the slack. That's what happened. So here's the materials sector. It was trading in this descending triangle. Look at this breakout early in the week. Could not hold it. Here's the industrial sector. Same thing. Really strong beginning of the week. Breaks out of the range. Cannot hold it. But the point is, these cyclical sectors really stepped up in the beginning of the week. It was really strange to see this rally because we had some horrible economic data that was just completely disconnected with what the market was doing. For example, Q1 GDP shows the economic expansion that has gone on for over a decade ended. GDP contracted by 4.8%, worse than expected, which was about 3.5 to 4%, the lowest level since Q4 of 2008 during the financial crisis. Now, keep in mind, this is Q1 GDP. The last 2 weeks in March did all this damage. So the point being is wait until Q2 GDP comes out. It is going to be horrendous. We got initial claims as well. 3.84 million people filed for unemployment on the week. That brings the 6-week tally up to 30 million people and an unemployment rate of about 18.5% from 4% just 2 months ago. What this tells us is next week's payrolls report out on Friday morning is going to be a disaster. Did not derail the rally in the first half of the week. So we also had a massive short squeeze, and it was basically a dash for trash. The stocks that led the short squeeze were some of the worst performing on the way down, so that would include the airlines like AAL, the cruise lines like Royal Caribbean. As a matter of fact, interesting stat, for the week, the stocks with the diciest credit rose 5%, and the stocks with the best credit only rose 0.5%. So you could say these were the stocks that didn't rally. People were looking for cheap, beaten up stuff. But what was interesting, I read Bloomberg this weekend, and what was interesting was that it was retail buying, and not just retail, but first-time new traders into the market. So E-Trade, Ameritrade, Schwab all saw record new signups of new retail traders, and they saw a surge in these traders buying stocks this last week. As a matter of fact, Google saw a surge in the search term buy stock. In Bloomberg's opinion, it's because sports betting is offline right now. Casinos are closed. As of Tuesday's close, the best performing stock in small caps in the Russell 2000 was Hertz Car Rental. You can see it right here, Monday, Tuesday. After gaining 34% in these 2 days, the very next day. So these are the kind of stocks that people were buying and chasing. Early in the week, I said, look, this is a really defined range. There's a good chance or a possibility that this becomes a bull trap. That's a breakout above the range. Traders are chasing it, and then basically a failure of that breakout. And from failed moves come fast reversals. So interestingly, considering what was being bought, the airlines, the cruise lines, retailers, restaurants, hotels, stuff like that, and then you consider who was buying it. We know these retail first-time traders were coming in. Warren Buffett just announced recently they have been selling their exposure in airlines. So you have these retail traders coming in, they were bidding it up, and the smart money was basically selling to them. But in any case, this is the area that I was talking about early in the week that could be a potential bull trap. And one of the reasons was as prices started to break out early in the week, 3C was showing some really weak signals. So here's 3C for SPY. It was confirming this run off of this Tuesday's low into the new week over here. This is the start of the week. So I've rolled it forward. This is Monday, and you can see what 3C did. It's showing weak hands. It's showing weakness into this move up on Monday. So that is a negative divergence, and that was occurring right here as the S&P was trying to break out of this big range. And here's what 3C looked like the rest of the week. So here's the breakout above the range. You can see 3C did not confirm at all. It went really negatively divergent as prices were trying to break out. Here's IWM or small caps, good confirmation coming into the week. But again, as we go into Monday, Tuesday, what happens over here? A negative divergence into these gains. As buyers, as retail is buying, we're seeing negative divergence into those gains higher. As of the end of the week, this breakout did not hold. Now that is the first step into a failed breakout or a bull trap. We didn't really break down too bad, but we did fall back. And price action on Thursday and Friday was pretty ugly, pretty bearish. Thursday morning, Thursday afternoon closed with a bearish consolidation Friday, and then closed out the week with a bearish consolidation. Here's the Dow, same kind of price action into the end of the week. And as you can see, also back into this range. So a failed breakout over here, or failure to hold that breakout. And then some of the growth sensitive stuff or cyclical stuff like Dow Transports. Again, real strong beginning of the week, breakout, failure to hold the breakout. Same thing for like materials sector, which was strong at the beginning of the week, failure to hold it, or industrials. Same thing. So you see these same ranges, break out the range, failure to hold it, and bearish price action into the end of the week. As you can see, there's a change in tone about midweek. This is the FOMC. Really no reaction to the FOMC. But what happened after that? We had Amazon earnings. Amazon had been on a tear into earnings, and then it consolidated into earnings over here. Let me show you 3C real quick. This is a 15-minute chart of Amazon. You can see this tear up. And this is earnings over here. So as it goes into earnings, 3C negatively diverges. Now that's okay because that can happen into a consolidation. So this is pretty much what happened. Going into earnings, Amazon stopped and started consolidating. There's earnings. There's a failure too. So we had a failed breakout in Amazon as well. Here you can see it on Thursday, right here, right before earnings, and a failure back below. This is a failed breakout. So we do have this change in character after Apple and Amazon report earnings towards the end of the week. And what is earnings season telling us so far? Apple, for the first time in more than a decade, did not provide forward guidance, and 80% of S&P companies that have reported so far have suspended their guidance. The companies are saying we're flying blind, we have no idea what we'll make, but the investors are bidding up stocks. Here's consumer confidence. This week it plunged. It's in red over here. This is the best forward PE for the S&P. It's more expensive than it was at the record all-time highs in February before all this happened, before the crash. And as you can see, historically, consumer confidence and the stock market are basically the same thing. So this week, or last couple weeks actually, we've seen this huge divergence, but this week specifically when we saw consumer confidence plunge. And while that's happening, investors are bidding up the valuation of stocks, even though we're flying blind. Okay, so I digress. Let's go back to what we were talking about. Change in character late in the week after Amazon and Apple reported. Thursday morning, here's the reaction to Apple, Amazon earnings, and then just before noon, something else happened. This is the reaction to President Trump talking about holding China responsible for their response to the coronavirus. Not a big reaction in the S&P, did sell off a little bit, as you can see, and consolidated bearishly to the end of the day, opened down Friday. I've been talking about market signals. Last week, we talked about crude and what Treasury yields have been doing, but the one thing that's been acting pretty well as far as the macro signals go were currencies. Currencies have basically been supportive of this rally, or at least neutral. They haven't been sending a risk-off signal. That did change a little bit this week. Here's the US dollar versus the offshore yuan. Here's the reaction on that news. That is the yuan being sold. That's the yuan falling versus the US dollar. This might be a little hard to follow, but let's try it anyway. Here's the US dollar versus the yuan in the top window. Here's the S&P 500 in the bottom window. These are daily charts. So look at the sell-off in the S&P 500. Okay, what was happening in the yuan? It was selling off versus the dollar. Then the yuan versus the dollar consolidates in this kind of big bullish flag, right? It's consolidating against the prior trend. What's the S&P doing? It's doing the opposite. It's rallying. So moves up in this pair are representing risk off. Moves down are representing a more supportive risk environment. So look at the last 2 days of the week. This pair is breaking out. What is happening in stocks? They are moving down into the end of the week. This move towards the end of the week does not bode well for risk assets. This is basically a representation of renewed tensions between the US and China. Think tariffs. That's one thing President Trump could do. This is the worst sell-off in the yuan since March, when the broader market was selling off. Here's the Australian dollar versus the US dollar. It bottomed about 3 days ahead of the market. And this has been one of those currencies that I've been talking about that's either been supportive of the risk-on rally or has at least been neutral, like over in here. What happened this week? It broke this trend for the first time. This is a 6-week trend that it broke Thursday and Friday. we get the same trend break in the S&P 500 at the 61.8 fib level. Now, as far as the other macro signals go, here's a 60-minute chart of crude futures. So they rallied 14% on the week. This is the first gain in a month. And they actually made a slight higher high above about, I think that's about 1825 or so. So crude oil acted pretty well on the week. And then we have Treasury yields. So this is the S&P 500 on a 15-minute chart and the 10-year yield. So we've been watching this negative divergence. But on the week, so the S&P was down 0.2%. The 10-year yield was up 5 basis points. So towards the end of the week, it actually gained a little bit. But most of that gain was towards the end of the week. And there was two things. The FOMC right here and the Fed once again tapered their bond buying down to about 8 billion from 75 billion. So that might have been what was causing yields to go up a little bit. And you also had over in this area an article from Washington Post that Trump was considering canceling the U.S.'s debt to China. If you held U.S. treasuries and you were China, what would you do? You'd probably sell them. So that may have been what was responsible for this. And Boeing raised $75 billion, I think at 5%. So this could also be rate locks. Either way, it's not a huge move. It's not negating this big divergence over here, but it's just a little odd to see at the end of the week. So S&P down 0.2% on the week, almost made it to this 200-day moving average and that 3,000 psychological level. On a weekly chart, ended the week with a bearish shooting star. Small caps weekly chart where I've been building a position. That is a big shooting star, and a shooting star is a probable reversal candle. IWM small caps did hold at that 50-day moving average. Back to IWM's weekly chart and that shooting star. Take a look at this. Ending the week below that level. And touching on volatility real quick, this is the VIX. This is a weekly chart. Bullish hammer here. The biggest 2-day gain in the VIX since the sell-off. Okay, so heading into next week, we have earnings, we have payrolls next Friday, which I think is going to be a disaster. You had this new thing on the radar between the US and China, currencies sending the first ugly macro signal that they have in about 5 weeks. Have a potential bull trap here with new money or dumb money chasing this up and pros selling to it. When you get a failed breakout, a lot of times you will get a very fast reversal. So I'm going to be watching this, and I'm going to be watching those macro signals. Like I said, crude had a pretty good week, up 14% on the week, but it does not negate the damage there. Sorry, this chart's not scaled real well, but it's the S&P 500, and in purple, crude oil. We saw crude oil giving a nasty signal over here. Look at what it has been doing as the S&P has rallied. So even though it bounced last week, this is a really ugly macro signal. That is not gone. That is not off the radar. I used this move to fill out my short position to add to it. I'm not done with it, but I did increase it this week into these gains. Okay, so I think that will do it for this video. If you liked it, please give it a thumbs up. If you have questions or comments, as always, just leave them in the comment section below. Check out the website. I did put up a free post. That was a members post, daily wrap this week. You can check out a little bit of the content there that members receive. Thanks, everybody. Stay safe. Have a fantastic weekend, and I will see you next week.